Welcome to the Retail Outlook by StackSource and partners. If you are joining now, we're going to be starting in 1 minute. So bear with us for 1 minute as we get going. Okay. All right. Hello, everyone, and welcome to the StackSource Retail Outlook for June 2020. I am joined by a couple of awesome partners from Locate.ai and Bull Realty that we are going to chat with about retail. So we're going to talk about retail from a real estate investor perspective, from a small business perspective. We're going to talk about the trends of what's happening in the data for the retail sector and why it matters to those that are real estate investors and related to them. So without further ado, we're going to jump into introductions and we are going to kick it off. All right, so I'm Tim. I'm the CEO of StackSource. So I founded the company. We launched in 2017 as an online financing platform for commercial real estate assets. We have hundreds of lending partners across the country, and we help real estate investors of all shapes and sizes get the best access to commercial real estate debt that is especially difficult today during an economic downturn and COVID. As the capital markets are in disarray, we're helping a lot of clients find financing from active lenders at this time.
Hey guys, I'm Joe. I'm the co-founder and CEO of Locate.ai. We are a technology-enabled real estate firm based in San Francisco. And our mission is to help the retail industry just be a lot more data-driven in their real estate decisions as it pertains to site selection. So we have the largest geospatial database really in our site selection space, over 180,000 data points for every location in the country. We're experts in machine learning, artificial intelligence. So we build a lot of models that really help, expanding retailers understand like who their customers are, what markets they should be going into, all the way down to how much revenue will they generate at this given location. So we look at foot traffic data, which I think we're going to talk about in this call, a lot of consumer behavioral trends, consumer demographics and psychographics and so forth. And additionally, we actually partner with a lot of brokerage firms and a lot of local brokers, and actually have a services arm within our platform that helps tenants not only understand the data, but also apply it to the actual real estate process.
Awesome. Thanks, Joe.
Yeah.
Oh, sorry, Will. I'm not trying to skip you.
Hey, Will Young, president of the National Retail Group, Bull Realty. We specialize in investment sales throughout the country. We really focus on the Southeast, especially in Atlanta, and we're working with both buyers and sellers looking for retail investment properties.
Awesome. Thank you, Will. All right, now we're going to have a minute each to talk about one piece of data before we jump into the question and answer. And the piece of data that I brought to the table today is 660 billion. That is the number of dollars that Congress set aside specifically through the PPP loan program for businesses, U.S. businesses, primarily small businesses across the country, to apply for what is essentially a grant, because it's a loan that can be forgiven if you're using it for qualified uses, which include payroll. The amount that each small business qualified for, and there are literally millions of small businesses across the country that took the government up on this loan program, was you qualified for 2.5 months of payroll expenses. They did this to try to mitigate and prevent businesses from shutting down and shuttering entirely during COVID when they had to close temporarily. And why 660 billion is relevant and why 2.5 months of payroll is relevant is the earliest loans were approved by the end of the first week of April. We are now entering mid-June, and nearly 2.5 months after these first loans were given out. And so we're going to start to see a wave of not necessarily maturities with these loans, because there is a longer period and many of them are going to be forgivable. But we're starting to see that 2.5 months of payroll come to an end as far as how much money the government is giving out to these small businesses. Now, a lot of them are retailers or small office tenants across the country that are keeping our real estate industry going. And so between June, July, and early August, as that money starts to come to a close, I think we're going to start to see the implications of how are businesses going to fare, how are tenants going to fare in paying their own people and staying open and in paying their rent. And can the country open before that funding dries up? Is an interesting question. And so that's my data point today, $660 billion, and think of it as running out by the end of next month. So Joe, what's happened with people actually going to these stores during COVID?
Yeah, great question. So I thought, one of the probably the most germane topics that we can cover in the retail industry is what are consumers doing? Because it really at the foundation of it all, consumers put money into retail stores, and there's a trickle up effect to landlords, lenders, and so forth, right? So what we do at Locate.ai, so we analyze over 180 million anonymous mobile devices across the country. Okay, so with that information, we can actually in real time track the different movement patterns of consumers across America. Okay, so what you're seeing here is a daily graph chart of how retail foot traffic has trended from the baseline period, which we called it, the first couple of weeks of February. I think it was Feb 1 to Feb 23. We called that the baseline period, and then every data point that you see on the graph is where foot traffic stands against the baseline. So right now, across the country, we're down about a little under 20% in foot traffic, kind of before the whole COVID crisis hit. But let me give you a bit of additional color here, because I don't think that tells the entire story. So if you look at some of the big cities across the country, it's actually far below the 20% number, 18% number right now. So just give you guys some numbers. Of the top 50 MSAs in the country, Chicago is seeing the worst drop. So they're still down 68% in retail foot traffic. Minneapolis, a lot of activity going on there as we see it in the last couple of weeks. They're down 68% as well. You got Boston down 64, DC down 59, San Francisco down 54. Kind of the list goes on and on. So the areas that are doing a little bit better, I'll point out Vegas. I mean, we saw Vegas reopen up right a couple weeks ago. They're back right around 5% in the positive. So you can actually clearly see, as regulation kind of loosens up, as consumers are getting a bit more comfortable being outdoors, the numbers are starting to go up. But some of the worst hits segments within retail, movie theaters down 96, fitness down 63, full service restaurants down 40. There's a lot of things that we await here. And what we're doing at Locate.ai is we're just studying what consumer behavioral trends are actually looking like, right, on a daily basis. So that's going to be one of the biggest factors that we believe is going to shape how renters, landlords, investors, asset managers actually make decisions in the coming months. And we actually publicize all this for free. You guys can look at it at locate.ai/retail-tracker. You guys can check it out there.
Awesome. Thank you, Joe, for explaining that and where we stand on the current foot traffic in the country.
Yeah.
All right, Will, you wanted to talk to us about markets and the 4 phases that they can be in market by market.
That's right. And this chart just recently came out, but it's a pretty good indicator for people who are looking around the country to buy retail. I think this came out probably about a month ago, so a little bit of where we are in these phases. We might have kind of dialed back. Like if you're looking at this like an hourglass, you see Atlanta is at 9 o'clock in the recovery phase. So because there's been a little bit more impact on the economy, I think you might have seen us a little bit closer back towards the recession phase. But since Georgia was one of the first states to open back up, I think we saw people getting back to business, and it's starting to see the traffic on the roads again, like you did pre-COVID. So that's a good thing. Usually, when you look at this chart that I have right here, you want to be buying at the bottom of the chart. You know, in the recession phase, that's when you're going to get the best deals. And then look at the markets which are going to be the best ones to invest in. You definitely don't want to buy when you're in hyper supply stage of the cycle there, because where we are in the cycle, I think it's a good time to be buying in all the states, kind of in all of the areas and metros to the left of this chart. And but there's a lot of good deals. I think in retail right now, what we're seeing is a lot more deal specific. So kind of look at each deal on a case-by-case basis, look at the strength of the tenant, because some of these tenants are actually coming out better after COVID. They've picked up a little bit more market share, and those are the ones that can make it through a time like COVID. They're usually strong tenants to invest in.
Got it. So the best markets are ones that are moving from recession to recovery here, which means they're absorbing more space than is coming online.
That's right. That's right. That means, the rents are growing. The vacancies are staying relatively flat. I think we're going to start seeing a surge in the vacancy rates. A lot of restaurants are going out of business. Hopefully the PPP loan can carry them through. But at the same time, it kind of depending on what sector of the retail that you're buying, really is pretty impactful as well.
Yeah. So let's talk a little bit about that. So we're going to have a few questions and answers. I encourage you, if you're watching live, you can comment on either YouTube or Facebook, wherever you happen to be watching us, with your own questions for Joe, for Will, and for I. I'm going to go through a few questions, and we're going to dig into some of the trends behind this data and why we are at the place in retail where we are and where we're going to be in the coming months and next year. But if you have your own questions, please do chime in the comments, and we'll be able to incorporate those as well. So my first question is for Will. Will, what are you seeing as far as a current sentiment from real estate owners and from buyers that you're talking to?
We had a lot of deals that were kind of right about to close or go under contract right as COVID hit. We saw a lot of groups kind of step back that were really sold on the asset, wanted to just kind of see how things made it through COVID. A lot of those buyers are coming back off the sidelines right now and reinvesting. It kind of depending on what the product is, where the property is located. I think the better location, the stronger the tenants, those are the properties that people are going for right now. I think because there was also an extension to the 1031 deadlines, that's also helped. And so it gave people a little bit more time to make sure that they wanted to reinvest into real estate and make sure there's light at the end of the tunnel. So I think good signs from what we're looking at. Some of the shopping centers that we're looking at had every tenant's asking for relief. Some of them had a few and some didn't have any. And if all the tenants are doing well, not asking for relief, that's a very good sign if they can survive even government mandated shutdowns. So
sure. Mentioning those that are on 1031 essentially their time is ticking. For those not familiar with the extension, maybe they know what 1031 is at a high level, but what is the extension that was put in place? How much extra time do people have? And are you seeing from buyers that they are trying to use every last day on that 1031 clock to wait until things recover? Or are you seeing they're just kind of waiting for the right deal and they might move now?
They might wait to the last day to identify, but that doesn't mean they're not out searching. It's always a good idea to get in front, identify the properties, make sure you don't want to get called at the last second on a deadline and then find out there's something wrong with the property and have to switch to something which may not be a good alternative.
Right.
I think most of the groups, the extensions went, depending on when the closing was, one of the extensions allows for people to identify by mid-June. And then the second extension extends that time to identify up to mid-July.
Right. Cool. So as far as timing, retail, so Joe, on your side, retail, the foot traffic is still down 18% from pre-COVID. You've mentioned that in large markets, it's actually down more, and in more spread out areas, it's recovered quicker.
Yeah.
How do we know when a major market that somebody may be interested in buying, how do we know when it's going to be really back?
Yeah, that's a good question. Right now, we don't. But I've been thinking a lot about, what are the early indicators that you got to be looking out for that help you inform how the retail industry is coming back. So I think there's a lot of things, but I think primarily it comes down to three things. Okay, so I think one is government regulation. Okay, so we're paying really hard attention to government, like how cities are reopening up, what phases they're going back out to, and I actually want to share some data points that so pretty strong correlation between regulation and traffic. The second is just consumers' psychology, right? So like the three of us looks like we're kind of stuck indoors right now. Like when are we gonna feel a lot more comfortable going out and grabbing a drink, or going out and meeting a friend at a coffee shop, or going out to a workout shop at a Soul Cycle? Like when are we gonna feel comfortable doing that? And I think the third thing, which is probably a lot more germane to more urban areas, is office, right? Like how are the big companies going to go back to the office, and all the retail surrounding those offices really depend on like those high rises being filled up from 9 to 5, right? The third, I think it's actually kind of interdependent with the office space, but I can share with you guys a couple of things I think is pretty interesting here. So if you look at, Tim, you mentioned, you reiterated that retail traffic is down 18.6% right now across the country. But if you look at some of the states that have reopened earlier, you actually see the numbers a lot more favorable. Okay, so for example, like South Carolina, okay, they reopened April 20th. Okay, they're actually positive 3% right now compared to pre-COVID levels. Okay, you look at Alabama. Okay, they reopened April 30th, up 2.6%. Texas opened early May 1, up 1.5%. Oklahoma never issued a stay-at-home order, up 7.4%. California, been a lot more, I think, conservative with kind of reopening up, still down minus 28%, right? Nevada up 10.7 with Vegas opening up. They opened up May 9. So you see a very strong correlation here with how the city officials and the governors are, instituting their regulations, and how just the state's general principles that are driving their decision making. I think as we look at kind of what's going on in the bigger picture of with all the protests going on across the country, with possibly, there's another study that came out today or yesterday that, that's projecting another 100,000 deaths across the country and just in the US due to COVID. Like regulation is probably going to be the earliest, I think, factor to look out for, because that will actually allow stores to reopen, and it'll actually, affect the consumer's ability to actually go out and psychology and so forth. But I would say those are probably the three indicators that we're probably looking out most closely with in terms of data today to help us be more informed on when retail will start reopening back up.
Got it.
Yeah.
So location by location, the
Yeah.
government and what they say and how people feel about going out are extremely important. How about different types of retail? Is there a type of retail here? Is there a sub asset class that is maybe at risk of never coming back? Is there someone that cannot weather, or is there a sector, piece of the sector here that cannot weather people staying at home for a longer periods of time, or consumer psychology will lead to that piece never really becoming what it was pre-COVID?
Like that's a great question. Here's my take, and I've talked to many very smart, informed folks in the retail industry, and they all have different opinions. so I'll start there. I think people generally tend to overreact to now. It's kind of the general feeling that I'm getting. Like we gotta like keep in mind here, like there will be a vaccine, and we don't know when that's going to happen, right? People say it's going to take anywhere from 6 to 12 months. Okay, vaccine will come. It'll take a bit to get commercialized and get disseminated, to most citizens in the country. Like things will get back to, what we call quote unquote normal eventually, right? So like I think a lot of people are saying like, hey, like certain segments of retail are forever dead. Like no, like people are, home fitness is growing and no one's going to go back to the gym. Well, yeah, like today, no one is going to the gym because, I don't want to touch the same equipment that someone else touched when I don't know if they haven't tested and there's no vaccine out. But like, I think we got to kind of think about kind of more long term here. Like obviously in the short term, there's some segments that are more heavily impacted. Like for example, like movie theaters, fitness, full service restaurants that are sit down that are less set up to do more takeout and delivery and drive through and curbside. Like some of those, segments are hurting more today, but there will be a need for full service restaurants 12 months from now, right? People will want to go out and join a group fitness class and go out and play some basketball indoors 12 months from now, right? So like, I think that just kind of bifurcating the long-term versus the now, I think is important. One comment I will add though, is I think there's going to be a lot of turnover. Okay, so I don't necessarily think it's hard to say like certain categories of retail are forever dead. It's hard to make claims like that today, but I will say that within categories, a lot of the stores, like unfortunately, they're not set up to endure another 6 to 12 months of what we're currently going through, right? Like Tim, you mentioned the PPP loan, like. Tremendous stimulus package by the government, but you get about 2.5 months of payroll, that these store owners are getting, but their store traffic is down 50% or 60% in some cases, right? Their revenues are down 70% in some cases, right? So it's just not enough to offset the decline in revenue that they're seeing, especially with the fixed costs and rent and some of the other occupancy costs that they're dealing with, right? So I think within each category, turnover is definitely going to happen, but some of the broader categories, it's hard to make a statement right now to say certain categories are forever dead in the long term.
Right.
Yeah.
Looks like we lost Will. I think he's going to be rejoining in a second. Technical issues that he dropped off. I'm going to skip to another question for you, Joe.
Sure.
So do you think that you talk to a lot of brands and you help brands find the best places, and then their next step is to negotiate with landlords exactly what they can pay, and because they know what type of revenue they can expect from that location. Do you expect that we'll see more revenue sharing leases being sought by tenants in the future? Have you seen that based on the brands that you're working with? Is it something that they're going after? Is that what they want?
It's definitely a term that's being discussed, but not as much as I would like. And even so this is a topic that I've thought a lot about and spoke with a lot of our investors who are in real estate over the years. And I would personally like the industry to point for the vector to point more heavily in that direction of looking at percentage rent as a primary way to negotiate leases, right? Like I think there's a lot to like there's you align incentives right across the landlord and the tenant. You protect the downside, you reward the upside, and especially today in today's environment, like what option do you have? I mean, a lot of experts in New York City are saying that over 25% of restaurants will permanently close. Some say up to 50% are going to permanently close. Like, what other option do you have right now in having fixed rent prices right now with a restaurant that is sit down restaurants that saw a 60% decline in traffic? Right. I would like for that to be more the direction. And I will say, compared to 5 years ago when I started the business, there's a lot more data out there to help tenants and landlords navigate through that, right? Like we've gotten very good at predicting foot traffic. We got very good at predicting future revenue earnings that tenants can make at certain locations. And I think it'll force the landlords and the tenants to think more critically about the actual fit between the tenant and the actual space. But the data is there and the revenue forecasting abilities are there for them to thoughtfully think through how to make the financials work on both sides.
Yeah.
Yeah.
I was about to ask a question for Will, and it looks like we've lost him again. Maybe he's having some difficulty with his internet, but we are getting some questions from the audience. A couple of these are for Will, and we'll wait for him to rejoin. But one of them from Robert Smith says, how are lenders underwriting retail real estate deals right now? I can actually take that since our business is helping commercial property owners finance their properties. Retail is the second hardest asset class that we've seen to finance right now. So obviously, number one being hotels. Hotels are almost all a workout scenario right now where there's going to be negotiation with the initial lender. There's going to be an infusion of new capital to keep something going, where equity is getting crunched and people are trying to avoid their equity being, completely squashed away. Retail, it really depends on a couple of things. One, the location, and what we're seeing in that location as far as the strength of the market and people able to support those retail centers. The strength of the tenants and the credit grade of the tenants is now more important now than ever. It's still just as easy to finance a Dollar General today that has an institutional credit grade on their bonds, and they have a corporate guarantee and they've promised to pay. That's basically like clipping a bond. If you talk about a local retail strip with mom and pop tenants of questionable quality, they're being strung along by a PPP loan and maybe an EIDL loan on top of that, and that's your main source of revenue. And if you're talking about higher leverage, that is not a great bet to get done. About 55 to 60% of the lenders that we work with turned off the spigot entirely for retail properties over the last 3 months, either at one point or still today. There are still lenders that can do it. They are more scrutinizing the revenue of those stores, the credit grade of those tenants, and saying, can they keep those rent payments coming? And that is becoming a central piece of the underwriting. It is not impossible. Figure that it's going to be lower leverage than it would have been 6 months ago. And that you have to be working with the right lender. Many lenders cannot get this done, or if a loan officer tells you he can get it done, you have to make sure it can get through their credit committee. And that's something that we help people with today as well. Will, welcome back on. I think you may be having some technical challenges.
Yeah, I apologize about that. But you bringing up a good point about some of the lenders kind of shutting off the spigot. I think that on top of people wanting to find out, kind of see where things go in the market is another reason people have been on the sidelines. So as that starts to open up, that's definitely helpful. What are you seeing now that they're opening back up? You were saying they're starting to scrutinize a little bit more. Down payment amounts.
Yeah, there's more rigor around the revenue stream and whether it's going to be there, right? And collections becomes an early question now. So collections used to be a due diligence item. Now it's an item right up front where you're getting your quote based on how were your collections last month. And that's happening for both office and for retail, and especially where you have a non-credit grade tenant. Leverage is lower, so you're going to need to come up with more cash. And sometimes not leverage being lower, but there are higher reserve requirements. A lender wants to put 6 months of principal and interest on the sidelines within the loan, so they can essentially pay themselves the principal and interest payments until they know. I've seen triggers where until you hit certain collections 3 months in a row. I've seen triggers where it's basically they have some test on the property to know that the retail income stream is healthy before they start to release those reserves back into the loan. So there are different structures, leverage. The good news is rates are still really low if you're working with the right lender. So US Treasuries are really low, LIBOR is really low. And so we actually have loan quotes and loans getting done in the 3s, a couple even in the high 2s as far as an interest rate percentage. I always hesitate to say that, and please don't think that every deal is worthy of a loan at like 2.85%. It is happening where there are credit tenants and the right sponsor in the right market. But rates are still at historical lows, but you have to understand there's going to be structure and there's going to be a lot of scrutiny to your tenants, your collections, and the health of the income of the property. Will, a couple of questions are coming in from the audience that I think you're going to be best suited to answer. One was also from Robert Smith. When will we see distress and lower property valuations show up? How long is the lag time until values settle where they're going to be?
Well, clearly, the real estate's not like the stock market. There's going to be a lag there. I think traditionally, before you see any of the properties where they've just shut down, that income stream's gone, and they may not be able to re-tenant or have large enough reserves. Depending on what those reserves are, usually it takes about 90 days before you see foreclosures happen. And what it's kind of like Warren Buffett saying, when the tide's in, everybody looks good, but when the tide goes out, you find out who's skinny dipping. So there's going to be a lot of people who were highly leveraged, and I think you'll start seeing those deals probably maybe in the next 3 to 4 months. But I think because of all the government programs and funding, that really helped save a lot of businesses.
Yeah. So I think some properties are going to be saved because of it. And I think other properties will also go into foreclosure, but it will take longer.
Right.
Because with my stat at the beginning, PPP funding of $660 billion, a lot of that's going towards rent and keeping businesses alive and keeping them paying their people. But those businesses may ultimately go out of business, some of them. At the same time, on the loan side, we have forbearance cycles. On the multifamily side, we have forbearance from government agency lenders. On the CMBS side, we have a whole forbearance, but then special servicing component where if you have a distressed retail property, there's going to be a period of time where your lender is going to try to work it out with you. Lenders are not in a rush to foreclose and try to get things to auction right now for a couple of reasons. One is because they are in good faith trying to help their property owners survive this, because they think they'll be the best people to minimize their own losses if they were operating them well before the crisis. But the other reason is I don't think anybody wants to be that lender that becomes the headline lender for foreclosing on everybody right now. No lender wants to be the first one to issue a wave of foreclosures and kind of lose those relationships with their clients and to gain that reputation in the industry. But they're not going to wait forever. Those properties that truly are destined for foreclosure, they're going to come. I think it is difficult to predict exactly when, but we do have a couple of hurdles. You can look at how many CMBS loans are going to special servicing, and that's going up. And you can look at the small businesses, and if things are not opening and this government funding is running out, later this summer, I think we're going to see a lot more action.
That's right. And I'm saying because a lot of these lenders are giving property owners time to work with their tenants. We're actually seeing that as a way to sometimes come in, restructure the lease, and put some things in like show and sales that can give some guarantees, which will actually make the center stronger in the long run.
Yeah.
When people come back to spending money.
What do you think the biggest opportunities are coming out of COVID as we We've seen foot traffic start to come up in pockets. We can talk about locations or asset classes, but if you're a retail investor today, what are the big opportunities to take advantage of here?
I think it kind of depends on the type of retail investor you are. There's a lot of opportunistic buyers who buy vacant building, and they're good at coming in, re-tenanting these spaces and adding a lot of value. I think right now, on average, there's like 10 commercial foreclosures in Atlanta alone per month. That number probably will go up, hopefully not too high, but we'll just kind of have to see with the duration and impact and of what that ends up being. But I think those value add, refilling a lot of the vacant spaces, buying at a discount, and I think that's where a lot of value add can be made.
Yeah, I agree with that. I think there's a lot of categories within retail that are struggling right now, but there's certain segments that are just faring just fine, COVID, no COVID, right? So if you think when you say value add investment opportunities, like think QSRs, for example, right? Like if you look at some Taco Bell's, KFC's, like some of the more kind of the lower end price point locations that have drive-through capabilities and so forth, like some of their year-over-year sales are flat during COVID. Some are even up during COVID, right? People are going out and getting more comfort foods. You look at grocery stores, right? Like I think the retail traffic there is actually right back where it was pre-COVID, right? So grocery anchored centers are faring a lot better, right? Convenience stores. You look at healthcare, right? Healthcare is becoming more, retail-esque in the last 5 to 10 years, right? With the Forwards and the One Medicals of the world, right? So there's a lot of different types of, I think, tenants that are going to be thriving, that have continued to thrive during COVID. And when you think value add opportunities of potentially just re-tenanting or repurposing, obviously you got to think beyond just retail, right? Into industrial and multifamily and mixed use. But just within the re-tenanting realm, I think there's a lot of opportunities there as well.
Sure. And a lot of businesses are doing that. They have a lease coming up, and they're able to take advantage of being able to stabilize it with their own occupancy. That's definitely a great way to add value immediately.
Yeah.
As you talk about QSRs, Joe, you're making me remember that over the last few weeks in New Jersey, where we've had fairly strict lockdowns, and we're starting to progress into like phase 1 recovery here. Yeah. A couple of restaurants with drive-throughs have had like 45-minute to an hour lines just for people to get a donut or for someone to get a chicken sandwich. And so there are tenants here that probably are big wins and are going to see big expansions, in addition to many that don't have that capital, they don't have the brand for it, they don't have the right setup for it. And I think there are like very strong stars coming to the fold now. Dollar stores as well. Grocery stores is like an obvious one that's been covered in the media. The fact that they're getting so much more attention versus sit-down restaurants. We have another question from Eric Friedman, and he's asking, do you see CARES 5-year carryback impacting the market? And if so, how specifically? Will, is this something you're familiar with and able to speak to?
I'm sorry, the CARES Act.
5-year carryback impacting the market and how?
I'm not as familiar with that, man. Okay.
We'll table that one. Or Eric, maybe a direct conversation with someone on Will's team afterward might be in order. Daryl Hayes is asking, what is the market pulse for equity investors regarding ground up mixed use development? Probably Will and I can both give a little bit of perspective on that.
Right. I think there's a tremendous amount of equity out for mixed use developments with the right concepts. We're seeing a lot of shopping centers that actually have become vacant, that are in great locations, are more valuable without those tenants in because of the ability to go vertical. We're seeing people from all around the country flooding money into those kind of projects. So I think if you've got the right concept and the right plans, and you're good location, you're able to get that fully entitled, it's pretty easy to get people to invest in that.
Yeah, I agree if it's a strong project and you're a strong sponsor, and I think that's as important now as it's ever been. You really need to understand and justify the business case. But if so, there is a lot of dry powder. There are people that want to take advantage of the fact that there are opportunities today. Development is one of the opportunities. It's not like the only opportunity. As we've been talking about, there are buying distressed properties and retenanting them is a huge opportunity. I don't think there are as many options on the debt side today for capitalizing a construction project as there were 6 months ago. We've seen debt funds that rely on the CLO market have dried up. We've seen other funding structures that are not possible today that were possible a few months ago. But for quality sponsors with quality projects, there's always money. If you have the right IRR and it's justifiable, there's always going to be money on both the debt and the equity side. And there is plenty of dry powder on the equity side and people looking for ways to deploy it. Cool. If we have any more questions, we're going to have just a couple more, maybe 1 or 2 more questions from the audience we'll have time for here before we wrap up. I'm also going to make sure that everyone has the contact info for both Will and for Joe and for their team, so you guys can see their platforms. And I'll go ahead and stick this up on the screen as we do our last question here. But if you want to get in touch with any of us, here are email addresses, or you can certainly go through websites and find some corporate phone numbers and get in touch with us or an associate on our teams. But here are our direct contact info for all of us. As we wrap up, I will say, what is one? Oh, sorry, we just got another audience question in. It's specifically asking about a certain market, so we'll leave that. What is one thought to leave the audience here with, both Joe and Will, about the retail market and things that people are not already talking about?
After you, Will.
Okay. Well,
that's a good question.
Yeah, I think that it's interesting to learn and watch from these kind of events that happen. I think there's going to be a lot of opportunities for people who need to reinvest because they're actually seeing who's going to be viable. You know, what centers are going to continue to do well, and I think there'll be a lot of opportunities. You know, like the silver lining here is there is the amount the financing is the interest rates are very low, and these guys at StackSource can definitely help you out.
Yeah, I think, you know, I might take this a slightly different direction. I think my kind of recurring thing that I've been kind of noticing over and over again is that, like, retail is going to be okay, right? In the medium to long term. Like right now, it's taking a beating. Like the confluence of, you know, the George Floyd protests, along with the crisis. You know, really, it's there's a lot of uncertainty that we're seeing right now, but I just continue to see a couple things. One is the continual innovation amongst retailers, like how quickly retailers, tenants, merchants are able to, like, you know, go online during this crisis and pick up e-commerce sales. Like that's spiked tremendously, right? For, you know, food services to quickly turn on other levers within their business to reduce their impact on the bottom line. Like it's been actually very inspiring for me to see how quickly these business owners are able to adapt to just bombs that are being thrown at the overall retail landscape. And then secondly, like we just see, like just through our data, that consumers want to get back out there, right? There's something about, you know, being together in a communal place and sharing a meal together, or being out and really enjoying time physically together. Like people want to do it. And I think the data really supports it, right? If you look at just like the increase in recreational areas or parks, a lot of these, you know, outdoor areas are up 20, 30% pre-COVID, right? So you kind of see the general consumer psyche kind of be at the edge of, wanting to leave and get back out there and support their local business owners. So I think, there's going to be a lot of turmoil. There's going to be a lot of turnover. There's going to be a lot of pain. A lot of, unfortunately, a lot of folks that do go out of business. But I think in the bigger picture, like I think retail will survive. It'll continue to innovate, right? And the leaders will continue to inspire us, and we'll be fine. 1 to 2.5 years from now, right? So we just got to endure the next 6 to 12 months here until the vaccine comes, and then we'll work our way back up.
Awesome. Well, Thank you, Joe and Will, for the closing thoughts here. There are a few other questions cycling in, but I'm going to ask those people to please reach out to Will and to Joe directly. As we close here, we'll keep the contact info for all of us up on the screen here. But Joe, Will, thank you so much.
Great. Thanks.
Thank you.